All right, well, welcome. Here we are, Tax Tuesday. I'm Elliot Thomas, manager of the tax advisors here at Anderson, and I'm joined by my colleague from the tax advising department.
That's right, fellow tax advisor, Barley Bowler here, CPA here in the state of Nevada. Welcome, everyone. Welcome from our Anderson Business Advisors headquarters here in Las Vegas.
Yep,
Good to be here.
Rainbow Studio. Good to be here. Toby's out this week, so we're helping out with that. Remember, this is our Tax Tuesday where we take questions from you. We're bringing the tax knowledge to the masses, as we say. And we're going to let some people kind of...
Don't act so excited.
Right, exactly. We're going to let some people pile in here. In the meantime, something like Toby always likes to do, if you just want to tell us where you're coming from, we'll see if where we got the farthest person
who's
away.
furthest away?
Right, competition.
Yeah, you guys know the rules. For anyone here for their first time, the Q&A, shout us out in the Q&A. Let us know where you're tuning in from.
Kelly?
Yeah, great to have you guys back in the chat. Plus, what's up? Go ahead.
Let's move down so we can see the chat coming in, see where people coming in from.
You use the Q&A, plus we'll be going over your questions today. So, but if you do have questions, I think we have an option where we can submit questions in the background as well.
Absolutely. Please, by all means, if you have questions, send them through the question and answer. And we have a whole team there. We got Matthew, we got Troy, Maria, we got Jeff Stolken, and others on there. These are all CPAs, EAs, or tax attorneys, and they're going to answer all the questions that they can for you. Again, it's just a time to have fun, answer whatever questions we got. Remember, all these questions that we'll be going over, and we're going to go through them here in just a second, they're all coming from you. So please, during the week, you can always submit your questions at email them to the Tax Tuesday at andersonadvisors.com. That's where we pick them out. Every week, we read through every question, or every 2 weeks, we read through all the questions and pick them out for the show, and we're going to go through those in just a moment. If you need a more detailed response, you can always go to the Platinum portal if you're one of our tax clients, or maybe you have to get a tax package for a consult or something of that nature. But we will ask what we can, or answer what we can here. But sometimes if they require calculations, a little bit more in-depth items, we probably need a different avenue to get those answered.
We're not going to give those answers live.
Right, exactly. With
Too much pressure,
calculations,
too much pressure.
No, we're not doing that. So anyway, we got, let's see here, people coming in from Australia.
Yeah, I saw
Okay,
in Australia. I was trying to,
that's
there it
probably the
is,
winner
there it
right
is.
there. Yeah, and I apologize, we had some mic problems, so we got the new one. Oh, Dublin, Indiana. There we go.
Right.
Very nice. All right, so we're going to get started here. You want to go ahead and through the questions here?
Yeah, let's hop in. We got a bunch of great questions to go over today, guys. As usual, these are your questions.
We're just going to read through them first here.
Yeah, I want to give you an idea, guys, of what we're going to be going over. Starting off with a couple kind of tricky retirement questions. These are great questions. Are there ways to withdraw funds from a 401k, a retirement account, without moving it into an IRA? Talking about a couple different things there, right? A sponsored plan versus an individual plan. We're also starting a nonprofit business, and how can we avoid that 10% early withdrawal penalty? Great question there. Question number 2, I attempted to do a backdoor Roth IRA conversion. We know what that is, right? An after-tax conversion. In December 24th, so did it at the end of the year. I'm a high-income earner, was not aware the financial institution had made a temporary change. There was some hold time for the funds. We made a deposit at the contribution at the end of the year. The question here is, the 7K post-tax contributed to the traditional IRA in December was not available to convert. We went past the end of the year to 2025 tax year, and we're wondering kind of how that's treated since the conversion was completed in 2025, but the contribution occurred in 2024. Is another 7K contribution allowed? It's a great question. We're looking at the timing of the contributions, because if we want to maximize the contributions, we got to know what kind of time periods we can fit them into. Great question about using an S corporation, an accountable plan for reimbursements. If anyone hasn't heard of that, you're going to have a lot of fun with this one today. This is literally getting tax-free cash back in our pocket. So that's actually going to be a fun one. So stick around for that one. How can we use this? Can we use this to reimburse for gym membership, supplements, wellness plans, stuff like that? Very common question. We're going to be going over that. My S corporation provides financial services. Another question. Talking about the qualified business income deduction, that 199A. That's a pretty good deduction, right? 20%, good chunk of deduction. Can we take that if we have 2 different businesses? How does that work? What's that look like? I have 2 LLCs holding trading accounts. So a couple different LLCs. We're going to talk about our trade structure a little bit different. We also kind of just what we call a safe asset kind of holding structure. If we have a brokerage account or high value collectibles or something like that. Couple different ways we can talk about that. Does putting a rental property into a disregarded LLC have any tax benefits? Definitely going to go over that. This is where we're inevitably going to blur the lines a little bit between asset protection and tax planning, right? They go hand in hand. We have kind of an order of operations, but does putting rental property into a disregarded LLC have any tax benefits? Can I transfer the interest of a disregarded to a holding company or to a living trust? Great questions. The trading partnership, this is our trade structure when we're talking about pushing a portion of the capital gains to a C-Corp trading partner. This is our trade structure. Toby's got a great video on this. Do I need a contract? We're talking about guaranteed payments here, a very unique sort of payment to partner. What are the pros and cons of holding real estate investments in a disregarded LLC, C-Corp versus S-Corp? Classic structural questions, definitely going to be going over those. Finally, we're buying our first short-term rental this year, considering using a third-party property manager. Can I manage the property next year with material participation? Great question. We're talking about a short-term rental, so we can skip that difficult real estate professional status test, skip right to the material participation test. So definitely looking forward to going over that. Great questions. I want to just give you guys an idea of what we're going over today.
But first,
you guys got to subscribe. Of course, we have so much educational material between Toby and Clint's pages. Toby focusing more on the tax planning, Clint more on the asset protection side. Of course, there's a lot of crossover there. Great videos on there.
and a lot of them.
And a lot of them, yep. Toby's up to almost 1,000 videos there. We're heading.
8.
That's right. Full speed ahead to that mile marker. And Captains of Industry, great. Boy, just did a recent one, a total kind of a twist for Toby, talking about different sort of nonprofit, religious-oriented investments, kind of very interesting. We have a workshop coming up. Tell us about the live events here, Elliot.
Yeah, we got, excuse me, tax and asset workshop coming up here. Saturday is going to be an online one. That's March 1st and March 8th. And then we have the live one down in Dallas, March 27th through the 29th. And that's just a great event. You can get down there, meet with other clients that we have, prospective clients. A lot of good networking, a lot of good ideas flow back and forth. Get to learn a lot. I always recommend at least going to one of these every year, just so you can keep up and make sure nothing's changed. Because a lot does change in the tax code and asset protection. If nothing changed, well, then you know you're good. But still, it's just a great networking, a lot of fun. And they do it at lowest dollar possible. It's not there to make money or anything like that. So the live event again in Dallas, March 27th to the 29th, but we do have the onlines on March 1st and March 8th.
Oh, nice. There's a lot of events coming up.
Yeah.
And we're going to touch on that in a little bit here too, guys, give you more information on that. All right, everybody ready to hop in? Let's put the tax hats on, hop right in. All right. Everybody. Oh, we had some issue with the camera. Yeah, we're good on the video on this end, guys. See if you want to log back off, log back in. Sometimes that helps if you need help with the video portion. All right, guys. Are there any ways to withdraw funds from a 401k? What's a 401k? That's a sponsored qualified retirement plan, not an IRA, right? Not a Roth IRA. They can have those kind of similar components. How do we get withdraw funds from a 401k without moving it into an IRA? Kind of a tricky question there, because we maybe wouldn't even want to do that from the first place. But then finishing, for starting a nonprofit business without incurring the penalty, what kind of guidance we want to get there?
Yeah, so your 401k, as Barley points out, that's going to be sponsored by a business. It's usually a business that you work at. It could be your standard job, your W-2 job. You have one at work or something like that. But then as an individual, you can also have the IRA. And that's something that you, again, as an individual, unrelated to your work, you put into it. You do have to have earned income, but nonetheless you can contribute to that, and it's a little bit of a different plan. It has different limits, far less limits of contribution, etc. But one thing they all have in common: if you take out money too early, you're going to get hit with a penalty, typically the 10% IRS penalty that's being referred to here. So in the bigger sense here, what we got going on, if we have this 401k, is there any way that we can move that money around, maybe into an IRA or something like that, that we're not going to run into that 10% penalty by the IRS? Quick answer is no. You can go, even if you moved it into the IRA, if your 401k allowed it, it's not going to be allowed to. It's still going to be incurring the 10% penalty if you ever took those funds out. But something unique that we have with the 401k, many of them have the option to take a loan out. And now if we take a loan, what we got going on there? Is that going to be taxable?
Well, the nice part about, hear Toby say this all the time, right? borrow, buy, die or something, right? Yeah, so when we take a loan, that's not income, right? It's not income. So we can borrow against the plan and we don't have to report that for tax purposes. There's no income.
Exactly right. Now, typically the 401k, it's going to have, of course, a limit because, we can't do too much of the lending or anything like that out of there, taking a loan. It's going to be the maximum
Right.
of 50% of the vested amount or $50,000, 50 being, whichever is less.
Yeah.
So we do have that kind of a limit, but in this case, we could, if the 401k, if this sponsor, the company that sponsors this allows for the loan, then this individual could just take a loan out up to about 5 years, 60 months, and then just slowly pay that back, but take the funds, go ahead and start their nonprofit. Absent that, I'm not aware of any way we could get money out of here without that penalty.
Yeah, and you wouldn't, I mean, a 401k plan, you might not want to move it into an IRA anyway, but
We do see, yeah, that's a good point. Now, if it was a 401k at their regular job, usually those are quite famous for not being very, very useful as far as investing. They're not as broad in what you can get into. Another thought here might be if they have another gig, a side gig business or something like that that could sponsor a plan, maybe they want to set up their own solo 401k. We set a lot of those up. You could move that over there perhaps. Again, it always depends on the rules of the 401k. Maybe they won't allow you to do it, but you can always check before you set it up. If you moved it in there, again, you'd still have the ability to lend, but you might have more flexibility in your investments.
yeah, and this is going to be a big deal for our W-2 employees transitioning to managing and running your own enterprise, right? You're going to pull that 401k and now create your own corporate sponsored plan, and that can be massive benefits. Solo 401k, a lot of our clients use that. Now, there's restrictions with other employees, but the majority of our clients are closely held, family-held corporations. That's going to be nothing but benefit there.
Very good.
10%, that's 59 and a half, I think, for the penalty. So that's generally pretty easily avoidable. There are some exceptions there, for some medical, home purchase, stuff like that. But let us know if you have any questions there. If you have a specific question on that, shoot in the Platinum portal. Let us know kind of maybe what you're thinking of doing with the funds. Well, they said for starting a nonprofit business. Yeah, we actually have an excellent nonprofit team here. Kareem, Savannah, they are in the Platinum Knowledge Room every Thursday from 10 to 11 a.m. Pacific, open nonprofit office hour. Kareem has worked with the IRS for at least 10 years.
A long time.
Yeah, a long time. A very valuable resource. Please join us there. That's the Platinum Knowledge Room, 10 to 11 a.m. Pacific every Thursday for the nonprofit open office hour. All right, keep it moving.
Yep. Another retirement question?
Yeah, another retirement. It's a good one. Attempted to do a backdoor Roth IRA conversion. I know that's kind of a mouthful, but it's, we're just moving funds from a traditional IRA to a Roth IRA. Attempted to do a backdoor Roth IRA conversion December 24 due to being a high income earner. I was not aware that the financial institution made a temporary change in the hold time of funds for the month of December. And the 7K post-tax money contributed to the traditional IRA in December 24 was not available to convert to the Roth IRA until January 2025. Since the conversion was completed in 25, but the contribution occurred in 2024, is another 7K contribution allowed for 2025 to complete another Roth conversion? The short answer is absolutely yes. And this is a great question because we're talking about timing, right? These contribution limits and timing. Where do you want to start with this one answer?
Yeah, so again, what we got going on here, we want to move money into a Roth because it grows tax-free. But our individual here has a traditional IRA that they put some money into. Now, normally one gets a deduction when they put it in there, but if you make too much, which we have here, a high income earner, then you're not allowed to put into that traditional IRA and get a deduction. So what you have to do is take money that's already been taxed, called after-tax dollars, and you can put that in as your contribution to your annual IRA limit, which is approximately $7,000. It's also known as post-tax money, is what's described here. So this individual puts the $7,000 after tax into a traditional IRA, and as it grows in there, if they left it in there for 30 years, it would it reinvest itself and grow and grow and grow. Those earnings would be taxable later on when you took it out. They don't want that. They want to get it into a Roth where it will grow tax-free. So the IRS even has on their website how to do this, and you can go ahead and take that amount and convert it into a Roth. You can change an unlimited amount of dollars into a Roth for a conversion because the IRS gets to tax it right away. So they're not scared of you doing that. You can't move too much. So the $7,000 is only the entry a limitation to the entry door of getting into the traditional. And again, this was with after-tax money. It's already been taxed. So this individual wanted to move it over into the Roth before the year end of December. It didn't happen. It got held up. But they had made the contribution. That's the important part here. They made the contribution into the traditional before the end of the year. And then we get into January, and that's where they are able to roll it over. But as we just said, there's no limit. We can move all kinds, we can convert all kinds of cash into our Roth. So then the question is, well, because it kind of got delayed and pushed over into 2025 until this whole event was done, can I still make a contribution in 2025 for yet another one? And yes, you can, because your contribution was in 2024 in this instance here. And so you're allowed to make another one in 25. The fact that it didn't get rolled over shouldn't impact that at all. And there you have it.
Yep. So you got your contribution limit, and then you have whatever amount you can convert to a Roth. And as Elliot pointed out, if you have $100,000 in the traditional IRA, you can convert the whole thing if you want. Now, that's a taxable event, right? So we got to be careful with that.
Right. But you can.
Right. Doing it in chunks may be good, maybe some good tax planning, but that contribution limit is going to be the same no matter what. Yep. And Charlie, just to let you know, Thursday from 10 to 11 a.m. Pacific, that's the nonprofit open office hour in the Platinum Knowledge Room.
Good people in there.
Yeah, the whole team's in there. Oh, thanks, Patty. You got to be a Platinum client. That's a good reason to become a Platinum client.
Yeah, right there. The best reasons right there.
It really is. You get access to, guys, let me just pitch that real quick. 5 days a week, 5 hours a day, staffed by a CPA, an attorney, a tax preparer, a bookkeeper, the nonprofit team, every day. I don't know of another firm that's offering anything like that. They're in there. Well, are they in there right now? No, they're not in there. They're gone for the day, but they'll be back tomorrow. So a whole team in there.
And it's usually multiple CPAs, multiple attorneys, multiple bookkeeping, et cetera. So, quite a staff there. And it is, it's better than waiting around for, trying to get an appointment.
Absolutely.
At another firm.
It's a great resource.
All
right, now we get into the, by the way, we have a team of financial advisors here that just have so much experience in that, and I rely on them heavily for all the retirement stuff. They just have so much experience in that stuff. Now we're getting into a little more of my debits and credits tax wheelhouse here. I have an S corporation. Can I use an accountable plan? We all know what that is, right? Accountable plan for reimbursements. We've been drilling that one, you guys have said. Can I use an accountable plan to pay for things like gym membership, ding ding buzzword, sauna membership? We could throw supplements and stuff like that in there, right? Very common question. Other wellness therapies, right? To support my employees' well-being and health. To clarify, these are not medical expenses. Ding, ding, that's kind of the key there, right? Medical deductions are treated totally different. When we have a wellness plan, it's just a common misconception. We can't take it as a tax deduction. That's kind of the bottom line. The IRS doesn't allow it as a tax deduction. Might there be some situations where you'd offer it to your employees and they get some benefit and pay a little extra tax to get those benefits, and they might appreciate that and that might help your business? That may very well be a good a scenario that's doable for you. Bottom line, we don't get a tax deduction for wellness plans. Anything that's not prescribed by a doctor, essentially.
Yeah, and again, everyone has a different definition of wellness if you look this up. So if it was actually having to do with a medical condition, well then maybe. But yeah, you're and rightly so. And our question here clarifies that they're not medical expenses, so we know that's not the case here. And yeah, you're just looking basically, a day at the sauna kind of wellness or something like that. That's not going to count. Again, just we always talk about it, but the accountable plan, that's something that is for employees. Here at Anderson, we typically will run with that with an S corporation or C corporation because our client owners are going to be employees of those. And you basically, it's a fancy term from the IRS. It means reimbursement, and you're just getting reimbursed for things. In this case, an S corporation, it might be for a home office or something like that, but we're asking about a wellness plan, and that's not going to be one that we can throw in there.
Great question. Not medical expense. Yep, great question. Very common. My S corporation provides financial services, including invoicing, payroll, and financial analysis for clients. Can I take advantage of qualified business income deduction under Section 199A, the Cubit deduction? Also, I have another business as a health insurance gig, sole proprietor, while I'm getting the other business built up. Can I take 199A from that business also? Can I take the 199A deduction for both the S corporation and the sole proprietor at the same time? What say you, sir?
Yeah, so first of all, our QBID or qualified business income deduction is just a part of the Tax Cut and Jobs Act from back in 2017. In its simplest form, it just says you get a 20% haircut or 20% deduction against your taxable income right away off the top from your business. It's not eligible for a C corporation. C corporation's got the flat tax at 21%. This was meant to level the playing field for all other businesses, your partnerships, S corporations, sole proprietorships, so they can all take advantage of it. And what do we have going on here? We have an S corporation. Yes, they provide services, and there are specific situations with what we call specialized trader services, trader businesses, where we might have some phasing out of that deduction. But absent that, here in the S corporation, it's certainly qualified for the 199A. It can take a deduction up to 20% maximum. Then we have another business, which is a sole proprietor that we're starting here. And again, that too is it's not a C corporation. It's a for-profit business. They can take advantage of it as well. And so, yes, you can have multiple businesses taking advantage of this, and then eventually it just all adds up on one line on your return front page. Yeah.
Yeah, and it's essentially exactly it's a tax software, kind of like an election. You're just going to tell the tax software this business qualifies for the qualified business income deduction, and then it carries right up to your adjusted gross income, right below your standard deduction. Get that nice big qualified business income deduction. There's some carry forward elements with that. Same with everything else, guys. If this applies to you and you have questions, please let us know. We could go into way more detail on this. There's a really fun calculation. We could do adjusted basis and all this stuff. If
W-2s.
Yeah, and because by the way, on a more serious note, if you have rental real estate, this may apply to you as well if you're managing your real estate. It's not just for, well, I guess traditional businesses.
Yeah.
Thank you. Yeah.
Yeah, it can get quite complex real easy, but simplified version of it, 20% off. And yes, multiple businesses can take advantage of it.
Yep, absolutely.
Great
question. I have 2 LLCs and each has a trading account. I find many times I'm doing the same trades in each account. So for whatever reason, we have 2 brokerage accounts and they're in 2 separate LLCs. My question is, can I close the one LLC and transfer the trading account to the other LLC that I want to keep? It's a great question. We deal with this a lot when we talk about setting up our trade structure for trading, right?
And we really ask about, we talk a lot about what an LLC means.
Right.
What do we got going on there?
If I can, will there be any tax consequences? Well, that's going to be followed up by a question from us to you. How is the LLC taxed, right? Taxed as. How is the LLC? It's taxed as, it can be disregarded, it can be an S-Corp, C-Corp partnership. We need to elect how the LLC is taxed. So that aside, assuming these are disregarded LLCs to you, that'll be treated one way. If we're trying to combine accounts into a partnership, into what we call a trade structure, setting up a partnership with a C corporation, that'll be treated a little bit different going into a partnership or disregarded LLC. Bottom line, can I transfer the account and keep the LLC you want to keep? Yes, you'll want to look at the tax consequences. How much detail can we go into that without knowing?
Yeah, so assuming that this is an LLC that's not a corporation, that is
right,
an
that's
SRC,
a good place to start.
Yeah, there it simplifies our question a lot, because you can take it, any LLC brokerage account, shut it down, move it over, or transfer it while it's live, if you will. There we have a phrase for it. It's called in kind, and you'll have to check with your broker to see if they allow in kind transfers. So we have brokerage number 1 under an LLC that's a sole proprietorship, let's say, and we want to move it into our other LLC that maybe is a partnership. Yeah, you can, as long as Schwab or Fidelity or whomever says, yeah, you can do in-kind transfers. It will take all your positions that you already have in there for this investment, that investment, and just basically transplant them over here. We don't have a problem. We're good to go on that. But again, if it's a corporation or an S corporation, well, we might have different considerations, because we can't just take things out of an S corp or a C corporation without tax consequences. So we'd have to look at that. That's kind of more of a consultation we'd have to sit down and look at. Absent that, though, and even putting into a trading partnership that we were talking about, where we have a C Corp that's a partner and maybe the individual, we do that a lot to get some tax benefits. We can shift some money over into the C Corp, get some reimbursements and things like that. That accountable plan that we talked about a little while ago, all that can be done. Now, if you shut down your trading partnership in LLC 1 that's maybe just disregarded, owned by you, Safe Assets LLC, and you put it into one of these partnerships, one thing we have to be aware of, when we move it over here and put it in here, we already had basis. We already had an investment going on. Let's say we bought IBM at $10 a long time ago. Now it's worth who knows what, a couple $100 or whatever. You have to track that when you moved into the partnership. So when later, if the partnership ever sells, you have to have that gain that occurred up to that point when you moved it in. It has to shift back to the original taxpayer. That's one thing that you'll have to be careful with your records. Just so you're aware of that. But other than that, there's typically no tax consequence. Again, if you can do that in-kind transfer, check with your brokerage account group. But normally we wouldn't have any tax consequence.
Excellent. Oh, and check out the trade structure. That may, you didn't mention it, but that may be something that, the client didn't mention that there, but that may be something that's of value to you. That may be what you're looking for there. Yeah. Does putting a rental property into a disregarded LLC have any tax benefits? Tax benefits. Can I transfer the interest of a disregarded real estate investment holding LLC to a living trust without tax consequences? Great question. And actually, neither of these things have tax consequences. No. I mean, generally speaking, right? But let's break it down. So we have a rental property. I purchased an asset. Usually it's easier to get financing in your own name if you've just set up an LLC. There's no lending history or credit or anything, right? So I may have purchased a rental property in my name and then we call it assign the interest to a disregarded LLC. Any tax repercussions there?
Typically not.
Any tax benefits? Kind of the same question, but no tax downsides. Any upside to that?
Typically not.
Not really. All we're doing is creating liability protection. All we're doing is limiting the amount of liability that we incur from this business asset. What we're not doing is creating a separate taxpayer, the need for a separate tax filing, right? There's no 1065 or 1120 or nothing to file with a disregarded LLC. Why? Because it's disregarded to the owner and reports on the tax return of the owner. No separate tax return required.
Now, when we do this, though, remember, this is more of an asset protection tool getting it in there, because if we don't have our asset protection, then all the best tax plan in the world isn't going to help a whole lot, because if you get sued, you don't have that asset protection, there's nothing to plan for. So it's important that you do have these LLCs and not always think of it from a tax perspective. There's a broader course of thought about this, but in this case, no tax benefit, but no tax harm either by putting it typically into a disregard. The only thing I could think of is at the state level, you might have a transfer tax in some states. Pennsylvania's a little rough on that. But other than that, you should be okay. And then certainly moving that LLC, having it disregard into the living trust, no tax consequence there either. But once you start get these building blocks, you may in time want to set up a management C corporation, and that could certainly play into it. And now all of a sudden we might have some tax considerations, but that's a little bit deep and outside of this question.
Yeah, the living trust, that's typically going to be a non-taxable event. We're just this is set up on the event of your passing. That living trust will just assume ownership of everything that it has been assigned to it. Ideally, everything, right? All of your assets will just immediately be owned by that trust. Now, this isn't my wheelhouse, but this is how we avoid probate. We don't want our stuff chopped up on the courthouse steps, right? We want our living trust to detail explicitly how that's handled. And we don't want the state involved in this. I might be biased a little bit, but. All right, good work on that one. Yeah, living trust is, again, go to Toby's YouTube channel there. Tons of references on there. That might be one of the more important things.
Well, definitely. I mean, what's the point of having anything if you don't know how to leave it?
Yeah, the four-legged stool, right? Asset protection, tax planning, legacy and wealth building. That's what that living trust is all about. And then business operations, right? We're running a small business, generating income. Excellent. Hey, what's this?
And more about the workshop. Again, we have the online event March 1st and March 8th on the Saturdays there. Then the big one, the in-person live one down in Dallas, March 27th through 29th. And then again, just a great opportunity to learn and meet other investors, like-minded, same questions. Many of them have been through the same things, the same concerns that you may have if you're a new investor. So it's a great networking opportunity. Get to have a lot of fun, meet everybody. We love seeing the clients there.
Yep.
And so it's a really great event. Highly encourage it.
Yep. Yeah, good time, good synergy. All right, what else? Trading partnership. We mentioned this briefly, our trade structure. So the question, I have a trading partnership with the C-Corp owning 15%, me 85%. So first of all, what's that? We'll do a K1 split for the two partners, one being the C-Corp, you as an individual being partner number 2. That can range anywhere from 1%, maybe all the way up to 20%, and that could be on the high end. That's going to definitely be a little bit of tax planning, going involved in making that decision. Just FYI, that's what we're looking at there. But so the question is, I want to have monthly guaranteed payments to the C corporation. Very specific animal we're talking about here. Guaranteed payments to partner. This happens in a partnership. It's a payment to the C corporation as the other partner. Do I need a contract between the partnership and the C corporation? We certainly want some sort of documentation there. Contract, yeah, we could call that a consulting agreement, kind of service agreement, but we would want some sort of documentation there. Do we have any explicit guidance on that?
Yeah, we want to remember what's really going on here is you're paying your C corporation, or what we're doing is we're paying a partner. Just so happens it's your C corporation. Nobody works for free, okay? I'm not going to do anything unless I'm paid to do it, and I have to have a written agreement to do so. There needs to be something in writing of what that job is. Our C corporation can be managing oversight and making sure the tax returns get done for that partnership, making sure that the brokerage accounts kept up to par, this, that, or the other. Whatever these services are, handling the bookkeeping, whatever it be, it's going to earn a fee for that. It's got to be reasonable, but we pay a certain amount for that. We call it a guaranteed payment. That's a unique phrase only for partnerships, okay? We don't deal with that when we're dealing with other structures that we do, just so you're in the partnership. But yeah, we want to have a written agreement because we want to know what those services are that are being provided. And then we use that, and then we go out and determine what the basis for that price is, or the guaranteed payment. What is the reasonable value of the services being provided? We want that all written out there. We often talk about having a guaranteed payment maybe every quarter or at the end of the year, but there's nothing that says you can't pay it every month. That's certainly fine. It's just that you want it written and that it's steady and it's consistent for the services being provided.
This can be a huge benefit too, guys. Boy, I'm looking at you, Marvin, Sam, Russell, Nicoletta. You guys have these trade structures. So when you start really building out capital gains in the trade structure here, you're going to shift a portion of that income off your tax return, take advantage of all these reimbursements. What happens if you really get some good income going? We're going to take a lot of these reimbursements. You might have a lot of income left in that C-Corp. That's why we make this guaranteed payment, because now the C-Corp has this thing called earned income. Now you can go on W-2 payroll on that C corporation, take a W-2, set up a solo 401k, all the usual suspects there for maxing out retirement contributions. Can't do that typically if we just have trading portfolio income. Am I on the right track there?
Well, we could. At the C-Corp, what's happening here from a tax perspective is, if I always use the example, let's say you had $100 a gain in stocks, and we didn't have this structure. All 100 hits your return. But in this case, we have 15% owned by a C-Corp. So automatically 15% of your gains are going to go in there, and you can distribute out that gain, that capital gain to it. And that is income to the C-Corp. It shows up on its return. It's got to pay tax on that. So you could take that and go ahead and probably pay yourself. But the guaranteed payment allows you to get more in there. Because if you're C-Corp, if you know its appetite for the 280A, that is having the meetings in your home, up to 14 a year, the accountable plan, that medical reimbursement plan, we have that on the C corporation. All those things, if they exceed that 15% amount that you have coming into the C corporation, we might need a little bit more. Good time for a guaranteed payment to get a little bit more. And what happens with the guaranteed payment? That is actually a partnership expense, which means that, again, if it's, let's say the guaranteed payment was $10, well, 15% of that would go as a deduction to the C corp. 85 or $8.50 would be a deduction on your 1040, and that's a deduction against ordinary income. So we can get more deduction on our personal return for that guaranteed payment as well, get more money into the C corporation, more to get reimbursed to us. It's just a win-win, but it takes careful calculation, takes good planning.
I know that's a little confusing, guys, it's just inherently, but the whole idea is, how much can we reimburse tax-free out of the corporation into our pocket? Start there and reverse engineer the whole process.
Absolutely. But yes, we need a contract.
Right. Yes, we need a contract. Oh, here's a good one we can kind of just pick apart from a bunch of different angles. So what are the pros and cons of holding real estate investments in a disregarded entity, LLC, disregarded LLC, or an S or C Corp? We may as well throw partnership in there too, right? Just go through the whole gamut. By the way, you can have an LLC taxed as a C Corporation, taxed as an S Corp. You can have a true C Corp. All right, any questions on that, please let us know. But yeah, let's look at the different kind of pros and cons and different options of how we can hold real estate. So right off the bat, we usually advise against holding appreciating property, appreciating real estate in an S or C corporation, generally speaking. It's because if we want to take that property out of the corporation at any point in time, it's treated as a sale. We'll owe tax on that if it's a sale. There are ways to avoid that, but that can just be a nasty surprise, and just kind of want to get that up in the front of the room there before you put your property in a corporation. We just want you to know about these repercussions. So S or C Corp, we generally recommend against that. Now, good uses for managing properties, a lot of good potential for managing there. But let's just start with our traditional structure, I guess, right?
Yeah. So again, it depends what we're doing with our investments. Okay. If it's a long-term hold, we put it into a disregarded entity, but it's going to be one that hits our personal return. It can go through a Wyoming holding. That could be a partnership or disregard to your 1040. Either way, all that rental income hits your personal return. That's where we're going to use the disregarded entity in that case. But what if we're flipping property? If we have a whole different purpose, it's not a rental or anything like that. Now, when we flip, that's ordinary income subject to employment tax. And if you do a lot of flipping, you might get hit with what's called dealer status. That means that if you did a lot of it and then just out of nowhere picked up a rental property that you decided to unload because you didn't want to keep it, they may hit with ordinary tax rates and subject to employment tax again, because the IRS has labeled you a dealer. You're used to it. You're used to seeing that activity on your return, and they don't know if it's inventory or not. So we can do the flipping in a C or an S corporation, whereas the long-term rentals we would put through the disregarded entity. Just as you pointed out, though, if we had the long-term rental in that disregard, we can use a C or S corporation to manage, and that can help shift some income over, giving you a deduction on your personal return against that rental income.
Very similar to the trade structure.
Absolutely, same concept exactly. We're just getting more money in our C corporation. Why? Because we got all those reimbursements. What are the big three of a C corp?
Medical reimbursements, accountable plan, 280A.
Exactly, right? Accountable plan. Underneath that, we're going to have that home administrative office, mileage reimbursement. Because if we got the office in our house, anytime we drive out of there, reimbursable mileage. So lots of benefits there. S corporation, we're not going to have the medical, but we're going to have the other two. We're going to have the accountable plan. We're going to have the 280A. So again, reasons that we want to structure the way we do. There's a lot behind it. We certainly want the asset protection, but we can shift money around with all these things. But we never want to put that appreciable real estate into an S or C corporation. Also, as you pointed out, in case you ever try and get rid of it or get it taken out, we have a problem there. But if we ever if we ever pass away, our heirs receive stepped-up basis only in the shares. The S corporation, let's say, has stock, it has shares. If the value of those shares is $1 million, which will be judged by the assets in there, say the house went up to $1 million, they'll get $1 million step-up basis in those shares. But the property
we can sell
itself,
the shares to.
Right, exactly. But the property itself, you had this house, this rental in there for 27 and a half years. You'd fully depreciated it. You'd bought it a long time ago at $270,000 or something like that. It's dropped down to no basis or very little basis. And so now when the new, those who inherit, they pick up the C corporation, what are they going to depreciate?
The whole thing.
Nothing.
Or nothing.
Without
the opposite.
Without the step-up basis. There'll be nothing there that they can go ahead and depreciate. So that's the pros and cons of how we do this. It depends what you're doing, number one. Is it a long-term hold? Are we flipping? But they all have their right place in the toolbox, and we pull them out and use them in the right capacity.
Right. And then just to break these out, again, with kind of the standard Anderson structure, we'd have a rental property held in an LLC wherever, in whatever state the rental is located. That can be disregarded. That's where your disregarded LLC will be holding a rental. Disregarded to a Wyoming holding company. That can also be a disregarded LLC or a partnership. Then we use an S or C Corp for management purposes. And just like Elliot said, we can set up the C Corp for flip properties, set up disregarded LLCs, disregarded to the C Corporation for flip properties. I know it's a lot of information, guys, but you've all heard this. Hopefully it's review for the most part. But yeah, so all these different entities, this is where your wealth planning blueprint, guys, this is where we achieve the small miracle of having your attorney and your accountant stay on the same page, literally and figuratively. This great document called your wealth planning blueprint. It's where we can look at tax, asset protection, all of the above, legacy planning, and all, for our platinum clients, you know what a valuable thing that is, I hope. Being able to see all our entities, retirement plans, all of the above, all in one place, very beneficial.
Absolutely.
All right, what else we got? Buying our first short-term rental this year, congratulations. We're considering using a third-party property manager to manage it in year one. Can I manage that same property next year with material participation and get the tax, excuse me, get the tax deductions with the cost segregation and bonus depreciation? I love this question. Somebody's thinking.
So the quick answer, yes.
Yeah, absolutely.
Yeah, so what do we get? We got, again, short-term rental. What's our short-term rental? What do we call that? What's our
Average stay 7 days or less.
Right.
Typically is how we're going to define that.
Yep, exactly. So usually it's your Airbnb, very quick turnover in the stay and all that. Has a little bit different presentation of what happens on the return and things like that. But we're using another manager. And remember, in any business, we have to look to that section, code section 469, passive activity loss rules. And this is just another business, a short-term rental. And if you pay someone else to do the job, then typically the results, the gain, the loss, whatever the income, the losses, they're going to be passive. And what happens with passive losses, et cetera?
Limited to how much passive income you have. If there's leftover losses, they can be carried forward. They're not lost forever. But we have these, you guys know, we got these silos of income, right? Capital gains, capital losses, ordinary gains, ordinary losses. Then we have passive income, passive losses. Bottom line, the losses can only offset the gains in each category, more roughly speaking, generally speaking.
So we got this new house. We know that we'll get down to the rest of the question here. We're going to do a cost seg and bonus. That means we're going to speed up how much deduction we can take, potentially quite a bit. And that's typically going to cause a loss. And right now, when we're paying someone else to do the job, third-party property manager, the resultant is going to be passive loss. Now, there's nothing inherently wrong with that. They don't go anywhere if you can't use them, but you can only use them against other passive income. If we don't use them against that, they're just suspended there. They wait and wait and wait until you either sell the property or you have another form of passive income. But what we're asking here is, well, that first year, what if I have someone else do the job? And then the second year I take it over and I am managing it, learned a little bit about it, studied up how to be a property manager for a short-term rental. Can we materially participate? And what is material participation?
Right, yeah, absolutely. You can materially participate. Remember, we're talking about short-term rental here, so we don't have to hit that 750 plus hour test of real estate professional status test. Only looking at the material participation test, the most common. If you put 500 hours in the activity, you're usually good to go. You are designated a material participant. There could be more than one, right? But if you put 500 hours in, you're the one. Now, you can also achieve that same status, accomplish the same test, pass that same test rather, by achieving 100 hours and more than anyone else. Now, this is where the property manager comes in. If the property manager only worked 90 hours and you worked 120 hours, then you're the material participation. Then you are the material participant. And yes, this does kind of require you tracking the time of the property manager, and that you got to guesstimate the cleaners and the property manager. You got to track their time to weigh that calculation of who is the participant.
It will be if you do have another property manager, though. You're going to have a tough climb trying to get up that hill. You want to be really the manager yourself. But you can certainly have other parties come in and do the cleaning. You mentioned any other work beyond, but you do need to track their hours, show that you put in more time than they did. That's usually another one that tests over 100 hours more than anybody else. There's 7 different tests for material participation, but really we only focus on 2 for this particular situation. But back to it, we had a property manager, third-party property manager the first year, so it's all passive activity. Now we're in year 2. We want to do a bonus depreciation cost seg, and we're going to manage it ourselves. Can we do that, number one? And if we do, are we going to get any benefit from it?
Right, absolutely. Well, the cost segregation study, great question there. We're going to look at when the asset was placed into service. That's going to determine what bonus depreciation percentage we use, right? 60 down to 40, down to 20% next year. So that'll be one of the first things we look at. Now, this is totally doable, right? This is sometimes people will say, hey, I want to materially participate, get that big deduction, then I'm out. I'm going to have somebody else rent it. We can do it the opposite way. That's fine. Have a property manager manage it the first year. You have some income loss, whatever the case, passive income or passive loss. Then in year 2, when you are the material participant, that's when we do the cost seg study, right? If you pass that test, any large depreciation losses from the cost segregation study, if they're considered active, they will offset your other W-2 income, your other active income. That's kind of the holy grail of tax planning. How do we touch this already taxed income, our ordinary income? It's usually very difficult to touch unless we have active business losses, which is what this would create.
And what's our cost seg? Why do we care?
Right, so we have a property with a roof on it and a cement pad underneath, and essentially that's our 27.5-year property. That's our 39-year property, residential versus commercial, right? But there's a bunch of other stuff besides 4 walls, a pad, and a roof. There's windows and fixtures and flooring and carpet and landscaping and all these other elements. We can break those out, apply the proper life to those assets, and what this will inherently do is speed up the depreciation process.
So we take carpet, it's always a good example. It's 5-year property on its own. In that house, before we do a cost seg, it could be 39. In this case, we're talking short term. That means commercial. It's going to be 39 years to depreciate that 5-year carpet. But we do the cost segregation, break it into its different components of life's depreciation lives, one of them being 5 years. Instead of being deducted over 39, now it's 5. So you're speeding up a whole lot of depreciation. That means you're going to have a lot larger depreciation deduction, more than likely incurring a loss. We're managing it this year, and so it's going to be an ordinary loss, and that ordinary loss will offset any other income on your return. And that's the real play here.
Yep.
Now, the bonus depreciation is something that we can latch on to the cost seg. And it just says that if it's any of the 5-year, 10-year, anything under 20 years, you can immediately speed that up even further. And then right now, and this year, we're at 40% here in 2025. Next year, it's supposed to go down to 20. There may be changes in the tax code. We'll have to wait and see. But nonetheless,
fingers crossed.
Yeah, but if this year was the first year and we wait to manage in 2026, we're still going to come back and look to the year that we place it into service, which was 2025. So we would use 40% bonus depreciation, not 20% bonus depreciation, even though we're materially participating in 2026. So we can flip back to the year that we purchase and put it into place into service, take advantage of that, and get a really nice deduction typically.
Yeah, that's a fun one. That goes over a lot of different aspects there. One last thing I wanted. Accelerated depreciation, bonus depreciation, those are kind of confusing terms, but essentially accelerated, it just speeds up the process. Bonus, that 168K is the extra we can take on top.
Yep. So very good plan here. If you want to take advantage of it, get next year, get that material participation. Yeah, I think we pretty much beat this one up. Yeah,
yeah, right. No kidding. Well, should we see if there's any questions to go over or hit anything we got?
Here.
I think we came to the.
Well, we got a question here.
Yeah.
Is it QBI for owners of sole proprietorships, partnerships, and S-Corps? That is correct.
Yeah, and fortunately, Elliot and I have Rachel, Jared, Dutch, all in the background answering the questions. Jeff's in here, Troy's in here, so we have an outstanding team. I would rely on them heavily for you're getting good measured information there from your advisors.
Questions.
Right.
Yeah,
that's great.
Only 6 left. So I think that was it for our questions.
Yeah, that's it for our questions.
We got any?
Well, make sure we check out the videos.
Get Toby over
everything we
1,000.
talked about. Yeah, right. Everything we talked about is on that. From the trade structure to what the difference between a sole proprietor and an S-Corp. The taxation differences. Using an accountable plan. I've sent that to hundreds of you guys. Maximally, how to use that accountable plan. You hear people say, "Hey, my business pays me back for my cell phone and internet, and meals, miles, travel, home office." How does that work? This is exactly how that works. That accountable plan video from Toby is an excellent resource. Yep. So check out the website, the YouTube pages, and definitely join us for the live events. Really looking forward to these.
Absolutely.
And any questions that we didn't get to answer, guys, Tax Tuesdays at Anderson Advisors. Email us your questions. That's where we picked the questions from, right? And any other questions that we don't get to here today in the chat, we'll try to get to all these. But if we have any left over we can't get to, please submit those to the Platinum Portal, and we'll get you an answer as soon as we can.
And there we have it.
Yeah, and do we want to go over any of these, or should we let the team handle these? And
I think there's only 6. Let's let them handle it.
all right. Trading structure on the side, full-time trading, material participation. Great questions. Yep. Oh, we got Ross in the chat too. We got the whole team here. Well, Ellie and I are just going to kick back. Let the questions get answered here.
We got Ross, we got everyone, and I think that's pretty much it.
And just to remind everybody, every day, 5 days a week from 11 to noon Pacific time is the tax open office hour. We're in there every day answering your tax questions. It usually gets taken up by all your great questions, but we can always go over topics of discussion. You want to talk estimated taxes, depreciation. Again, guys, 5 days a week, 5 hours a day, lean on that service. We're all in there just waiting to answer your questions, so come on in. All right. We're going to get your questions answered. Thanks so much, everybody. Any questions that don't get answered, submit into the Platinum portal, and we will see you in 2 weeks. Hopefully, Mr. Mathis will be back answering questions then.